Hi everyone, so welcome to Investing for Value. Today I'm going to talk about oil tankers, and this is going to build on a prior video I made where I talked about the financials and the fleet sizing, and hopefully this builds on top of that by talking about some of the questions that you guys had asked and some of the company highlights. Mind you, this is just a brief review, and if there's any company that you're more interested in after this video, I highly recommend you do some of your own research before doing any buying. So since this video is going to be quite long, let's just jump right into it. So the question that a lot of you guys will have is, how long is this going to last for? So if we look at the current factors where there's more supply than demand, which is leading to an effect called contango, where the present price is lower than the future pricing because currently the world's just not at a state of normal. So the demand that would normally be there is not there, though everyone kind of imagines that the demand in the future is going to be much higher, hence why the future pricing is a lot higher rather than the present pricing where there is no demand. And it creates a situation where you can buy at the present price and sell it in the future at a much higher price, and then you can make the difference in profits, right? So as you can see in the June contracts, it's $13.85, and in July it's $18.40. That's a $4.50 difference. And if you imagine you can make that difference on 1 million barrels of oil, that's $4.5 million. Though you still have to factor in storage costs, and if you take a portion of your $4.5 million and you hire out a oil tanker, you can just hold it there and make some good profit. As highlighted in this article, oil prices drop, but tanker storage costs are soaring, and it's basically summed up in this sentence: tankers are in demand and your rates were as low as $25,000 a day in February and have ballooned to nearly $200,000 a day, even hitting $300,000 at a point. So as you can see, it's a great situation for oil tankers. And even then, if the current situation right now doesn't last too long, by fall and winter, they actually anticipate oil consumption to be increasing, particularly as you know in winter people will consume more. And in Northern Hemisphere, this is from the Nordic American Tankers annual report, and this will be the same for all oil tankers. So I can very much see the situation lasting for at least all of this year, if not into next year as well, which kind of gives me a bit of more confidence to hold these stocks for a bit longer. Though, you could see the situation more differently. So yeah, I guess do a bit of research, and then you can see how long this might go for. Though, in my view, as long as this effect called contango is still in play, this should still be a very good situation. So in terms of how companies like to hire out, lease out their fleets, rather than getting the market pricing, so as you can see with the market pricing being very high, not all companies will be getting this on all their fleets, because they're going to have time charters where they lease the fleet on a long-term basis, but there would also be a percentage of fleet where they will get spot charters, which is the market rate, and it's the market rate that you guys want. And also a thing to factor in is that oil tankers have a life of about 20 to 25 years, and as we can see here, there's quite a few ships in Nordic American Tankers fleet that are actually quite old, some at 2002. So if you imagine, the life of these ships won't actually be that much longer. So after this period where they make a lot of money, a lot of these ships will be needing to be replaced. So when you research into these companies, do look at the fleet age, because that will have some impact in the future when they might have to use that money to replace those ships. And as we're talking about Nordic American Tankers, this is like the market darling of this situation right now, where it's the stock that's doing extremely well, though I expect the other stocks to catch up eventually, though this company is taking the lead, because as in March, the CFO they were buying 60,000 shares at $4.72, and that was a really good sign that insiders saw great things coming. And also in March they were getting some very good rates, as much as 110,000 for an 18-day charter, $90,000 a day for 55-day charters. Though, you know, like, that's the high pricing. There was low pricing of 26,000 for 40 days, 43,000 for 40 days. So it's a whole combination, but in general they're getting very good rates, particularly when you consider their operating cost was $8,000 a day. So these rates are extraordinary when it comes to this company making some really good profits. And also in March they announced that they were buying back 4.5 million shares, though I don't know if they want to continue that since their pricing is much higher than the previous months. In March their pricing got as low as like $2.50, and now it's at $7.34, so almost triple that pricing. So, but I think it's a big sign when the company kind of sees their shares being undervalued. CFO is buying, and now they're getting some really good rates. The CEO was also on CNBC saying they were getting $70,000 a day, and they were locking in contracts as long as 6 months, which is a very good sign and a very good rate, that by the time they get out of this 6-month contract, it will be winter for the Northern Hemisphere, and they will get some very good rates after that. So that's all the highlights for that. Now it's down to Frontline. So Frontline's been doing fairly well as well. Their share was around $8 at the start of the month. Now it's at $10.47, so some decent profits can be made as well here. Not as high as Nordic American Tankers, but still very good. And as we look here, these were some of the highlights. So in the quarter 4 of 2019, they were getting about 58,000 for their very large crude carriers, 38,000 for the Suezmax, and 29,800 for the Aframax. But you can see here in the first quarter of 2020, they were estimating that they were going to get significantly higher rates, 90,000 for the very large crude carriers, and 71,900 for the Suezmax, and 36,300 for the Aframax. And this is the percentage that was done at these rates. So that's some pretty good percentages when we look at all these different situations. So as we can see right here, they talk about their different fleets. So they had 19 very large crude carriers, and all of them were on spot rates. And in for the Suezmax, they had like 69% on spot rates, 23% at time charters, and then 8% at market-related time charters. So as you can see, majority of fleet of these ships, like the Aframax, 94% at spot rates, Suezmax 69%, very large crude carriers 100%. So this company is very much getting exposure to the market rates, even though some of them are fixed. The majority of the ships will be getting the upside right now, and that's a very good situation. And also right here in March, they closed a situation of 10 Suezmaxes, and this is also going to allow them to get some very good market rates, particularly in March, where the rates are starting to increase significantly, going right into April, where the April rates were the highest I've probably seen in a long time. Alright, so that's our Frontline, and then now this is DHT Holdings. So DHT Holdings has also been doing quite well. Like a month ago, their share price it's got as low as like $6, and now it's $8. So that's only if you brought this dip here. If you were held here, you would be breaking even right now. So it's not a bad situation right now with these tankers. Yes, here we go. They did a decent deal here where they leased 6 of their ships for 67,300, and that basically that equaled, for 6 of their ships, that was about $121 million down to basically their bottom line, like their earnings before interest, depreciation and tax, and that's just for 6 of their ships, which is pretty extraordinary when you consider their fleet size is around 27. Though they did lock on some low rates before that, so they had here 4 ships that expire in between 2021 and 2022, and the rate for that was only 31,500, though they still earn some decent margins from that, though not as good as the ones here where they're doing it at twice the rate at 67,300. And yeah, that basically lets you know what the situation of DTH is, though most of the other tankers are still continue to be at spot rates, which is very, very good for the situation right now, where all the fleet is very large crude carriers, and very large crude carriers are in good demand. Alright, so that's just, let's go to the next one, which is like, I don't know how to pronounce this particularly, so hopefully I get this right. So Tsakos Energy Navigation. This company has been at around 400 million in market valuation, hence why people are pretty interested in the stock, because they see the low market valuation and seeing a big upside. So over a week ago they were at $2.65, and now they're at $4.18. This is one of the stocks that has been rising as much as Nordic American Tankers, and they are doing quite well as well. So as we look at the situation here, a lot of their fleet's actually on time charters. So as you can see here, most of their Suezmaxes and their Aframaxes are on time charters. I counted about 41. They've got a fleet of 65 vehicles, and about 41 of them are on time charters, though some of them expire in the next few months. So that then they're going to be able to put those vehicles back out and get some very good market rates. Though some of the contracts are quite long, going into 2022 and 2023, which means they will not be available to take advantage of the really good rates right now. But that's okay, you know, at the end of the day, it's still a very good situation if half their fleet is going to get some extraordinary pricing, and at 65 vessels, that's not bad for a $400 million company, right? So this is a little snippet of their longer term contracts. So basically, here's a situation where they said they achieved an attractive long-term contract in the middle of last year, where they were getting $23 million for a 36-month charter. So this charter basically is equivalent to $21,000 a day. So if they called this quite attractive, just imagine what it's like getting $70,000 a day that Nordic American Tankers was talking about. So if they called $21,000 quite attractive for TNP, you can imagine why Nordic American Tankers is doing so well, because they're getting significantly higher rates than this. Though, you know, at the end of the day, I think all oil tankers are going to do well, including this company here. Though you just have to bear in mind that a lot of their oil tankers are on fixed terms right now. So they might not be making a lot of the, you know, really good rates, though they will though if this lasts all year and their ships come out of expiry and are able to lock in much higher rates, this will be a really good situation for this company here. Alright, so let's move on to the next company. Alright, so now I've got Euronav. Euronav has also been doing fairly well. You could have brought the stock as low as around $9, and then if you had it now, $11.90, still not too bad profit for like a month. Though, if you brought these high prices at the start of the year, you will still be holding and you'll be hoping for higher pricing. One thing that they've been doing as well is they've been selling their older ships. They sold a 2001 ship for $20.8 million, which is quite incredible, especially for a 2001 ship, because 2001, that's basically close to the end of the life for the ship, and they were still able to get some very, very good pricing on this, and this was for a Suezmax. So in terms of their fleet sizing, they've got 46 very large crude carriers, and they've got 2 ultra large crude carriers, and so for these 2 ships here, they've got 4 ships that can do about 3 million barrels of oil or more, whereas the very large crude carriers do 2 million barrels of oil. And then they've got 26 Suezmaxes. And here they highlight that 13% are on fixed rates and 87% are on spot rates. So that's great. Like 87% right now can get some very, very good rates. And this company is going to make some massive, massive profits because they have such a large fleet. As long as they don't fix those rates at extremely low terms, they can get some very high rates. I wasn't able to find what rates they were getting. Though I think the CEO did mention that they were going to be earning like quite a few years of profits from just a few months. So you can imagine that this company is going to make so much money. So at a 2.5 billion valuation, the question is how much more. Like, I think they should do quite well. I think they have a good chance of achieving the 2015 pricing of like $15 or even higher than that, though we'll have to see how that goes. Though it's depending on it's this situation where no one's actually seen this situation before, so it's very hard to tell where the share price will go. Though I guess since they're such a large company, the upside's not going to be as high as a smaller company. Alright, so let's go to the next one. So this one's Scorpio Tankers, where this share price hasn't been doing too badly as well if you bought at these lows. Though if you brought up here, it's, you're still holding on. And this company has kind of a very diverse fleet of ships. They've got 13 very large crude carriers, 2 Suezmaxes, 5 Aframaxes, 13 Panamaxes. And this basically creates like a fleet of 40 ships. And here this gives you an idea of the pricing they were getting. In the fourth quarter, this was the pricing they were getting: $54,000 for a very large crude carrier, $50,000 for a Suezmax. So you can see the very large crude carrier wasn't getting that much more than the Suezmax because there wasn't that large of a demand for the larger ships. Though you can see in quarter one, very large crude carriers were getting $75,000, whereas Suezmax was getting $57,000. So the very large crude carrier pricing actually rose much quicker. Though recently the Suezmax pricing was slowly catching up as well. So it kind of lets you know, in terms of demand, that the big ships are in demand, and then as the big ships run out, the smaller ships will be in demand. And this lets you know how much of that is fixed. So 74% of their fleet was fixed at $75,000, which is a very, very good rate. And 71% was for the Suezmaxes were fixed, and 66% of the Aframax was fixed. So at the end of the day, they did fix them at very good rates, particularly the very large crude carriers. The Suezmaxes, if they managed to hold out until April, they would have got some very good rates, though I think most of this was fixed during March when the rates were not as high, though they're still very, very decent rates. So yeah, like for this company, I'd say it's not too bad, especially when you look at their fleet of ships. 13 of them are very large crude carriers, so they're getting a very decent upside. Alright, so here's the next company, SFL Corporation, and this company is also done fairly well in this month, so like a nice uptrend for this stock. And if you brought as low down here as like $7 and held to 11, that's quite a decent return. So this is a company that's quite diversified. It has 50 of the container ships, and in 22 dry bulk ships and 11 tankers. So in terms of the oil exposure, they're not getting that much of the exposure. It's kind of like a very diversified portfolio. So this one, like, if you wanted to get a little bit of upside but you weren't sure and you wanted something that had a good long-term situation, maybe this would be what you're looking at. But this company mostly just leases out all their ships. So as you can see with the contract durations, it's like 8 years, 7.8, 5.6 for their oil tankers. So this company doesn't really get that much exposure to the market rates. So I wouldn't see the big upside for this company. But you could be buying it for a different reason. But if you're buying it for the oil tanker exposure, I would say you wouldn't be getting that much from this company. Alright, so next company is Diamond Shipping. So this company's also been doing really well lately. You could have got their shares at $9.15, and in right now it's at $14.42. And they've got 66 vessels. Only 16 of them are crude, like oil tankers, whereas 50 of them are product carriers. So product carriers, like product tankers, are like for refined crude oil, which is also doing very well itself. So all 66 ships of theirs will be in good demand. Here you can see that 20% of them were on fixed contracts, whereas 80% of them were on market rates. So this company very much gets the upside of the market rates. And the fleet age is not too bad as well, as for most ships they can go up to like 20 to 25 years, and most of their ships are nowhere near that, so they won't be needing to renew too many of their ships. So here we go, we can see the different ships that they have. Like, a lot of them are very small ships, and you can see that they have spot rates, and even the ones that were fixed, some of them expire in 2020. So if the situation lasts for quite a few months more and these ships become available again, they're going to be able to get the very good spot pricing. So they have a mixture of the big and small ships, and as I mentioned in the like with the other company, where the rates for smaller ships is actually starting to increase. So a company like Diamond Shipping is actually primed to actually get the full benefit of this situation. Though they only have 66 ships for this situation, so like I feel like you can get another company with a bit more exposure to the oil side, and that would get some better rates, because some of these ships are quite small. Though if the small ships are getting some decent rates, then this could be quite a good company as well. Alright, so now it's Capital Product Partners. Basically this shipping company can be summed up as they own 32% of Diamond Shipping, and basically that makes up a majority of what they do. So, and that's hence why the market valuation is $178 million, because it's basically a third of whatever Diamond Shipping is. So there's not that much to talk about this one. So if you buy into this one, you're basically buying into Diamond Shipping plus a little bit extra. Alright, so last company, Teekay Tankers. So Teekay is basically, it's in a very unique situation, where I think it kind of confuses everyone around the company, because you hear about Teekay and then you see Teekay Corporation and you buy into this one, and you've actually end up buying a company that also owns two parts of these So the way it works is Teekay Corporation is a company that is the operator, and they thought about just basically splitting their fleets into different entities. So all three of these are listed companies, but if you buy TK, you also get some exposure to LNG, which is liquid natural gas, and they have a 33.9% interest in this company, and they have a 28.8% in Teekay Tankers. So if you want to buy for the oil market exposure, you want to buy Teekay Tankers directly, while if you buy TK, you get the exposure from both sides, and you might not get the upside of the oil situation, though currently both sides are doing very well, because there's also quite a big demand for storage for natural gas and crude oil. So this might be a situation where you see it as a diversified situation, though if you just want to invest in natural gas, you just buy TGP, or if you want to buy into crude oil storage, then it's TNK, and hopefully that kind of clarifies the difference. And yeah, currently the situation, where am I? So this is for Teekay Tankers, and as you can see here for the Suezmax, they were getting some pretty decent pricing. So in Q1 of 2019, they were getting 23,600 a day, and by Q4 of last year, they were getting 39,000, and then by the first quarter of this year, they're getting about 51,700. So you can see this pricing is moving dramatically. Say, like the Afromax, not as much, but still some decent upside. As you can see here, for Q1, 77% was booked, so meaning they still had some extra capacity to get some higher market rates when they came available, and same with the Afromax. So yeah, so if this is this is more like they've got a lot of ships that are more like smaller ships, which gives you exposure to the it kind of lets you know that basically they're getting some decent rates, and they're going to be also a very, very profitable company. So as you can see, all the oil tanker companies are going to do very well because the rates are extraordinary. So hopefully that answered some of the questions around how long the situation is going to go for, and what market rates people are getting, like, well, what oil tanker stocks are getting, and what other people are paying basically. And that basically gives you a good idea, so that some companies will have a lot of fixed contracts and they're not able to get the highest rates, whereas some will be on the shorter term and they'll get some very high rates. And it's just a mixture for basically, as you can see, all the companies. There is a decent proportion that is fixed, but majority of them are for market rates. And that creates a situation where basically I think all of these companies are going to do very well, and I don't think there's a problem regarding which one you choose. No matter which one you choose, as long as you hold within the next few months, I think you're going to do very well out of it. Hopefully that was helpful, and if you have any other questions, just comment below. I'm always happy to answer some of the questions, or if there's any other companies you want to talk about, always happy to talk about those as well. Until then, good luck investing, everyone.